We are officially live, broadcasting only on onedealaway.com/live. My name is Nev. This is Money Matters, and today we're going to continue where we left off yesterday, talking a bit more about real estate. As you know, yesterday we talked about how Zillow is getting into the house flipping business. They don't do it exactly the way that you and I would, but very, very similar. It's just slightly bigger and, well, with a bit more connections. So, and of course, they do have a benefit that most of us don't, of like, publicly traded and money coming in and that kind of stuff, right? So, but today we're going to be discussing a little bit different things. We forgot to, well, we didn't forget, we just didn't have time to do it, to talk about the interest rates and where we are right now. And you will see that we are, well, flat over the last week, pretty much flat over the last week. We're also going to be discussing of what's happening with the United Wholesale Mortgage, UWM. If you will recall, this is the company that was offering those super, super low mortgages that none of us could get into, right? Well, we could get into it, it's just you can't get it directly from them. There's a bit of news, and they are going public. That's right. So that's an interesting one. We're going to be looking at what's happening a bit in New York City. We're having one of the major hotels actually filing for bankruptcy and kind of closing. And it makes sense if you're thinking about real estate and that sector of real estate as a whole, that, it's a hospitality sector, and we know that people are not traveling. They're not going places. Well, there might be some, but not nearly as what we used to have, right? So they are suffering a big deal, and we're going to be talking about that piece as well, in addition to what's happening in New York City and how jobs are actually preventing real estate. So if you go out there and you promise jobs, they don't want you to develop. I know it's contrary to what would make sense, but you will learn where we are in the new normal and why people are fighting against it. We're going to be looking at the home sales, and they are hitting 14-year high. And of course, we're going to be looking at what the future of housing is, right? So we are talking a lot about affordable housing and how that's really, really important. But is it being built? And if not, why not? And if it is, why it is? And we're going to be discussing all of that today in this episode. So, if you are in real estate, if you want to get into real estate, if you are an investor, this is just an interesting sector to you, you definitely want to be watching today's episode where we're going to be discussing all these things. I do want to welcome everybody watching live on onedealaway.com. Please sign in, say hello, and as always, we're going to do Q&A at the end of the show. If you're watching this elsewhere, do me a huge favor. Smash the like button, forward it to friends, subscribe, hit the bell, and I will see you every single day, because we do this every single day, and you will get properly notified so you don't miss a single episode. All right, let's do this. Well, here we go. Good morning. Happy Friday to you. I hope you have something fabulous planned for the weekend. I know I do, and I will tell you at the end of the show of what I'm doing. But now, let's get to business. Let's do this. All right. So here we go. We're looking at the mortgage rates, and as you can see, this is obviously this week right here, right? Because today is what, 25th, so a couple days old. Not too bad, not too bad, right? And you will see that it's predominantly flat. The jumbo went slightly down. The 5-1 arm slightly down. And then you will see that the 15-year fixed rate didn't move at all, still sitting at 2.53. And the 30-year fixed rate went slightly up from 3.09 to 3.1. And if you kind of look at where we have been going, I mean, you will see that we are definitely moving on down in just about every, well, not in just about, in every single one of them. And, you'll see right here at the beginning of June, The 30-year fixed rate mortgage was 3.43. This is the average, right? But now we're at 3.1. 15-year was 2.8. Now it's 2.53. 5-1 ARM was 3.39. Now it's 3.2. And Jumbo was at 3.85. And now it's sitting pretty at 3.52. One of the interesting pieces still for me is that it's still much more expensive to get the adjustable rate mortgage, the ARM, than it is a fixed rate. And again, that still tells me that they are still expecting it to stay flat, potentially going somewhat down. So that's an interesting one. In case you're still shopping for mortgage or refinancing or that kind of stuff. And I think it's always good to know what's happening on the lending side of the business, because we do know that it is very much interconnected, right? And not that you have to borrow money to buy a home, but vast majority of people do. It's just the amount of leverage that is different, and it differs from person to person. Now, we did talk about the fact that UWM was doing all of these crazy mortgages, and we've been covering that stuff as it shows up. And if you are interested and curious to watch it, simply go to the YouTube channel, Money Matters with Nev K. And if you go into the real estate section, you will be able to find it. I want to say it's, we've done a few different ones as they rolled out over the summer months. So that's where you'll be able to find the stuff. So, but now UWM is going public, and it's going in the biggest SPAC deal. Now, we've also covered what SPAC is. It's a special purpose vehicle that basically goes out, lists, and then takes the money and then acquires the companies. So, United Wholesale Mortgage is merging with Gores Holding 4, or IV, I'm not quite sure, a special purpose acquisition company, and preparing to go public in the biggest SPAC deal ever recorded. The deal will allow lender to go public at a valuation of more than $16 billion. They will take 94% stake in the new company, and they basically, if you're curious and you don't know much about them, they work with independent brokers to service mortgages, and they are on track to underwrite nearly $200 billion worth of mortgages this year, which is up from $108 billion in 2019. So as you can see, mortgages are definitely up 100%, almost 100%. So they basically doubled in what they're doing. And of course, they're going to go out there, they're going to get funding, and then they're probably going to continue jumping in and investing and likely acquiring some companies. Will Martinique Hotel in Manhattan be one of the things they acquire? I don't know. Why would I mention that name? Well, here is why. We are getting a news that they are actually filing for bankruptcy. The operator of the Martinique Hotel in Manhattan has filed for Chapter 11 bankruptcy protection. The company owes between $10 million and $50 million and has estimated assets in between $100 and $500 million. The hotel's 123 employees were laid off as of March 18 for a quote-unquote temporary plant closing. Clearly, it's not very temporary, and especially if they were laid off. Now, J.P. Morgan Chase is one of the biggest creditors, and the company has obtained $14 million mortgage from them. And so they are basically hoping that Chapter 11 will enable them to basically continue to sort of operate and reduce some of these expenses and restructure. But we'll see how things are working. Now, of course, we do have news from the other hotels as well. Hilton, for example, announced it would permanently close its 478-room hotel in Times Square as of October 1, and Courtyard by Marriott in Herald Square also shuttered its doors as of August 24th. Now, this is very, very important, and I do have more news about New York and real estate. And as you can see, the city is suffering a great deal. Will it ever recover? Probably. Will it recover, in 2020? Probably not. 2021? probability goes slightly up, but it's not as high. I would suspect it's going to be 3 to 5 years, and then of course, a lot of it is going to depend on government, on what happens there, on the policies, on the laws, on the rules, regulations, all kinds of different things, and all of those things are going to drive what is potentially happening or not happening in the city and how fast it recovers or doesn't. In New York City is, I mean, it's the Big Apple. Everybody knows about New York City, but as you know, people have been leaving. They're not coming back. They're leaving permanently, and typically, folks that leave first are the ones that have higher means. Of course, we've talked about the fact that when they leave, they also take their tax dollars with them, which means that the city's not getting as much taxation. Well, where do taxes go? Well, they go different places, and one of those things is to basically public service of the city, like city maintenance, trash and water and public transportation and streets and police and fire departments and all of those different things that, more often than not, we take for granted until we don't have it and need it. And so this is one of those things that's really interesting to me to kind of watch because, these places, for example, East Coast, West Coast kind of thing, they tend to sort of be the first ones to kind of happen things and then sort of trickles down. Now, how much trickles? It really depends on what it is, but we definitely end up seeing it, and we potentially could see that some of the major metropolis are going the way of New York City. Example comes to San Francisco and Seattle and Portland and LA, maybe San Diego, potentially Chicago, maybe Boston, Miami, right? You know all the major cities in United States. I don't have to tell them to you. And we could see that some of these struggles and challenges are coming. And of course, we are seeing news all over the place that they're all challenged in different ways, but challenged nonetheless. And now, excuse me. And now we are seeing that hotels are starting to shutter down and leave. Of course, restaurants are doing the same thing. So even if you wanted to go and visit these places, it's becoming very, very challenging. And of course, if you live in a state that you're deemed a red hot, super infected state, then you can't even go and visit. You have to quarantine somewhere, and sometimes hotels will let you do that, sometimes they won't. So you're taking a bit of a gamble when you try to travel, which is making even more challenges for the hotels, for the restaurants, for the airlines, and that kind of stuff, right? So as you can see, that's kind of what's going on now. One of the things that you would think is that, with all of these challenges kind of coming in, that, folks would want to welcome the jobs and job building. And of course, this brings us right back into the city. Remember, I told you that we all know that real estate and jobs are very, very connected, right? If people don't have jobs, then they can't afford to pay for mortgage or rent. And if they can't afford to pay for that, well, housing is not doing all that hot. Now, of course, we do have rent moratorium until end of the year, right? So we do have that happening. We do have all of these forbearances and different things that are happening, but it's not a solution to the problem. At the end of the day, those dates will come, right? Whether we want them or not. And if the bigger solution is not reached, meaning how are these people going to pay for stuff at the end of the day, we are going to see potentially a bigger problem. Now, could they expand on the moratorium for rent? Absolutely. Election is going to tell a lot. We just don't know who's going to quite win and what they're going to do in the future. Right now, it might make sense to try to move some stuff on one side and try to prevent it on the other side. And so we're seeing this battle back and forth, and we're seeing it with, the stimulus and all these different things that one side wants it, the other side doesn't, and they're going back and forth. And it's all really about winning. Once that wraps up, then I think we're going to see some things potentially move a bit faster because you're not fighting over the hot seat of where you're going to sit on the throne or not. So anyways, that's one of the things that we're seeing now. New York City, I told you that there's a new thing that is developing, and it's the beliefs of the people. And here is the part that is very scary to me when I think about it. Let's take a look at this particular story because I think it's going to explain a lot of what I am concerned about and why. So this is, let's just kind of look at it. A year after Amazon's stunning defeat in Queens, Industry City's capitulation in Brooklyn marks a new low point for the real estate industry. The owners of the 35-acre Sunset Park campus withdrew their rezoning application Tuesday night as mounting political opposition doomed its chances in the city council. Decision makes clear that Amazon's abandonment 19 months ago of a multi-billion-dollar headquarters planned for Long Island City was not an outlier. Now, you likely know if you've been paying attention that Amazon, for a while was looking for sort of their like second headquarters, and they were going out there and trying to bid, blah blah blah. Well, New York City was one of the contendants, and they didn't go with it. They basically abandoned the project, and this particular story kind of explains as to how that all happened and why. For decades, the promise of jobs greased the paths for projects needing political approval. Now it kills them. Amazon declared in 2018 that the HQ2 second headquarters. Let me see if I can make this bigger. Would serve 25,000 to 40,000 employees, making an average of 150,000 a year. However, some of the activists and elected officials said, "Ooh, we don't like that idea." Now, you are thinking like, wait a minute, why don't you like the idea? They're coming in, they're saying we're going to provide jobs, a lot of jobs, and they're going to be good paying jobs for people. Well, they didn't like that, and this is the part that is scary for me. Here is what they had to say. They said it would bid up housing and trigger landlords to raise rents. Amazon CEO Jeff Bezos, seeing this approved is inevitable, canceled the plan in February of 2019. So they're basically saying, look, you're going to come here. You're going to build your headquarters. You're going to hire all these people, and these people are going to get paid, and they're going to have good jobs and good money. And then these people are going to need a place to live. So they're going to go out and buy homes. That is going to raise the prices. We don't want that. And those that don't buy homes, they're going to go and rent, which means the rents are going to go up, and we don't like that either. So they said no to jobs to keep the prices low. The core issue was that its primary benefit, employment, was viewed negatively by certain locals and their political representative. Job means gentrification. Jobs means displacement. That narrative was so powerful that even when the word I can't say, the beer overflow wiped out millions of jobs, chased several hundred thousands of the city's wealthiest out of town, and sent rents tumbling, its believers clung to their position. Now, Industry City, which made jobs its primary argument for allowing more retail, office, and academic uses, was toast. It had estimated the rezoning would lead it to invest another $1 billion in the complex and nearly double the number of jobs there to about 15,000. However, the current political environment and lack of leadership precludes a path towards our rezoning proposal. City Planning Commission, which de Blasio controls, did approve the rezoning proposal, but only 3 city council members came in favor of it. It needed 26 of their votes to actually pass. Development debates in New York once hinged on employment promises. And for politicians that struggled when all of the changes were happening in the 70s, right, and maybe even the 80s, understand and are basically saying, hey, we need jobs. We need to bring this stuff in. However, for younger politicians, that's certainly for politicians of a certain age, but I'm going to say younger politicians, attracting employers is an automatic act akin to breeding, right, for them. For those of older people, sorry. A new generation of activists came to age in a city as adding nearly 100,000 jobs a year, and for-profit developers were building apartment projects at record pace all over the city. And of course, this all became associated with rising inequality and higher rent. So they look at it as a negative thing and are saying, I don't think so. We are not interested in doing any of this stuff. Go away with your stupid jobs. We don't want the jobs because jobs mean more people coming in. And if people come in, they're going to raise the prices. So clearly, there's some lack of understanding and education there. Sure, is it possible that the prices are going to go up? Absolutely, right? Is it possible that there might be some gentrification? Sure, yeah, it happens, right? But is it also possible that the city is going to go down the drain if they don't do something to fix it? Meaning to figure out ways how are we going to pay for all of these different things? Absolutely as well. So we here we are, and this is like I said, this is one of those things that while it might be happening in New York City, or you might be hearing about these things in like Seattle or San Francisco or that kind of stuff, I think it's a sentiment of where we are in the social construct of the population, of kind of where we are and who we are, right? And we are having two very, very different views and opinions that are highly polarized, so to speak. They're complete different ends. And one is saying, no, 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 we got to create the jobs and housing and that kind of stuff. The other side is saying, absolutely not. We're not doing that stuff. Where's it all going to end? I really don't know. It's probably that we're going to be at this battleground, that there's going to be some areas like New York City that are probably going to suffer a bit more over the upcoming months and potentially years. I do believe that what they're known as second tier cities, where they're like, big enough and close enough where you want to live and you want to thrive, and there's all kinds of things happening there that's like still city living, but it might not be necessarily like New York City, right, or San Francisco. And so you still get all the benefits of the city without all of the other politicking and that kind of challenges. So I see those areas potentially growing in demand, in command, and that kind of stuff that is happening. And as things start getting worse, there's a couple of different things that could transpire from there. One of those options and possibilities is that people will acknowledge, oops, we made an error, we got to change our ways, right? And sort of learn from those that are thriving. So that's option one. Option B is you become even more sort of stuck to your own views and opinions, and we start sort of these social wars. Hopefully it doesn't turn into a war or a revolution or anything like that, of us versus them. And so we'll see how it all rolls out, but overall, I do see very tremulous and turbulent future for us in the, relatively speaking, short term. Now, short term doesn't mean necessarily, today, and doesn't mean even this month or this year, although, of course, it is. But I also see it potentially rolling into 21. But again, we'll see. A lot of things can change with the new leadership and kind of new guides and, all of that stuff. But, um, it's not going to change fast enough, I don't think. And so I think it's going to be very, very turbulent between now and probably spring of 21. So do pay attention to that stuff. And good luck to us all, as they say. I don't know how you feel about it, so let me know in the chat. Let me know in the comments, of depending of course, where you're watching, because I'm curious to know how you feel about the whole thing. Are jobs a good thing or a bad thing? Do they raise rents and mortgages and stuff, and is that a bad stuff, or is it good that we have jobs and that people are getting paid a better living wage? So I don't know, and we also know that over the decades, the real living wage has actually been going down, right? Not in, like the amounts might have gone up and stuff, but when you compare it to all of the costs and everything else, the actual like real wage, when you reduce all of that, has been steadily going down. And of course, you can always fact check me, and you should, by looking that stuff up on your own. Now, we do have some other really interesting news, and that is that the U.S. home sales hit a 14-year high this August, from August of 2019. Sales of existing homes reached a 14-year high in August, according to a report from National Association of Realtors. And these sales include single-family homes, townhomes, and condominiums and co-ops. And these rose 10.5% from August 2019. This week, the Mortgage Bankers Association reported a 25% year over year increase in weekly volume of purchase loan applications it tracks. Further gains in sales are likely for the remainder of the year, with mortgage rates hovering around 3% and with continued job recovery. This is coming out of the National Association of Realtors chief economist. Now, the housing market could face down headwinds in December when federal eviction moratorium ends, and they are saying here leading to a number of homes being foreclosed upon. Now, it's very interesting that they are, federal eviction moratoriums is not, it's two different things, right? There's one that is on the renters, which is not going to lead to a number of homes that are being foreclosed upon, and everybody else, well, they can actually go into forbearance, and these can be renewed. So you can renew it from 3 months to 6 months, 6 months to 9 or 12 months. And what we are seeing and hearing on the ground is that lenders are actually very, very willing to work with folks. Whereas forbearance before meant that you would have to pay everything up front that you owed. What they're doing right now is just tackling all of those months at the end. So if you end up being in forbearance for a full year, for example, and you are, 20 years, left on your mortgage, well, now you have 21 years. So they're just tackling it on a back end. And then some of them are restructuring it all together. So for me, I don't see a huge number of it, because here is the problem, right? It doesn't benefit the mortgagers or mortgager, whatever, the banks, the people and companies providing money for mortgages. It doesn't benefit them to foreclose on everybody, because if they do that, the panic sets in. If the panic sets in, the buyers pull out. If the buyers pull out, then there's more supply than demand, meaning prices go down, which means more people start actually being underwater, starting to walk away, and you have this vicious cycle that opens up. Now, it's one thing, it's easy for me to say, forget it, I'm foreclosing on you, if I know that there's a line of people behind you. But they understand that that's not necessarily the case scenario. Of course, we're seeing it right now, mostly because the inventory is super, super low, and the demand is still holding up, predominantly because people are looking to still expand, take advantage of the super low rates and that kind of stuff, right? So all of those pieces are coming to play. And so I don't, unlike most of the folks out on YouTube that are talking about, crash is, here, and it's going to hit in January, I don't really see that coming. Is it possible? Yes. Is it going to happen in January? No. The earliest that it has a potential to happen would be summer 21. Into the fall is a bit likely, more likely probability, but even then I don't expect it to be super, super high. But again, we'll see. My crystal ball broke years ago, and you shouldn't take anything that I share here with you as financial advice. I'm just sharing my thoughts and opinions. And here's the reason why I believe that. Uh, um, Mortgages and real estate is very slow moving, and so it takes a while for that stuff to kind of transition, right? And so it's not like you're in default today, we repossess tomorrow, right? It's not like car loans or trading on margin or anything like that. It takes months for all of that stuff to roll in. So you have to be basically out of the forbearance, right? And then still fail to continue to fail to pay and restructure and stuff for months and months and months. Then you have to receive all these multiple notices. And then depending whether it's a judicial or non-judicial foreclosure, that's when we can start the process. And so it's a very, very slow unwinding. So right now things are still, going relatively well. And in order for me to think that it's going to go poorly at the beginning of 21, well, we would have stopped and slowed down and turned that corner already. And that's not necessarily happening. And it doesn't sound like it's going to quite happen yet. Again, I could be wrong because all of the data we have is lagging, and so that's another challenge with real estate is that you're trying to kind of move forward, but all of your data is in a history, right? And so you're driving forward, constantly looking at the rear view mirror, and that makes it a bit more challenging to try to accurately predict what is going to happen for sure. Now, builders are struggling to keep up with potential buyers' interest in new and existing homes. Meanwhile, total housing inventory at the end of August was 1.49 million units, which is down 18.6% from 1 year ago. This is huge. This is the part that I was telling you that builders can't keep up, and existing inventory is low already. And but the demand is still holding high, and that's the reason why the prices are going up. Last month, the median existing home price rose 11.4% to $310,600, up from $278,800 in August 2019, according to NAR. Now we're seeing this median home prices and stuff to differ, and here they're saying existing, but we've seen it when they're just saying median prices, and those are listed closer to 340,000, which then lets me believe that those, when they don't say existing homes, are likely including the new developments as well. The Northeast trend is also showing very, very strong increases, with the existing median sales jumped 13.8%. And they're up, the median home price is up 10.4% from August 2019. Because lenders are not able to file foreclosures, there have been so far very, very few distressed deals. Distressed sales or foreclosure and short sales represented less than 1% of sales in August, down from 2% at the same time last year. So because of all of this stuff, we're not seeing as much of it in the distressed market. Of course, they're still out there. They still exist. A lot of times these banks, I remember back in like 2009, 10, 11, the distressed sales from the banks were sweet, sweet, sweet deals, because they kept them at cost or below, way below the cost, and you could find some amazing deals at that time. And boy, did I. Some of them, I found that I couldn't afford at all. Some of them found, and I decided, hey, it's time to jump in, and I did, and that's basically how the story begins for me. Well, it's just the middle of the story, began way, way, way before then. But nowadays, you can go in and find that is a bank, foreclosure deal, right? The REO. That the lender owns it, and it's not as sweet of a deal, man, because they understand that, hey, there's still more buyers than sellers, and they are typically selling it above the price that it costs them, right? So they're actually making extra money on it, because not only will they recollect of what they have lost, but they're selling it at a higher price, and they can do that now that there's less of these. If they end up basically crashing the market by foreclosing on everybody, well, then the story changes for all. And the final piece that I wanted to share with you is that we have basically where we are for the future of the housing. And it's basically a mixed bag of things, right? And here is an article that really talks about this stuff. Now, we have a home ownership rate versus consumer debt, and you will see home ownership rate is this blue line, right? And you can kind of see it goes slightly up, slightly down, right? And, we've hit the kind of high, then we hit low in the 80s, into the 90s, then we had the really good high in the early 2000s, and then, of course, we all know what happened. And since then, the home ownership rate has actually been going down. And we hit the lowest, basically, this is what, I would say 2016 maybe, right? Since then, we have kind of come up slightly, but we're still in that 64 percentile range. Now, the household debt, which is the red line, has been continuously climbing, and we saw a slight sort of dip down here in 2008 till about 2011. Then it continued to go back up. Then we saw a little bit in 2015, right? And it's continuing to go up. So we're definitely seeing that the household debt is going up, and it doesn't appear to be connected to housing as much. I mean, sure, I'm sure that there is some, but it doesn't seem to be connected because when I look at this stuff, I just don't see it. Now, again, you let me know what you think and what your opinion is because I'd love to hear it. It doesn't mean that just because I have an opinion, it's the correct one. It's just my opinion. The three sub indices of the National Association of Home Builders hit record high. They present present single family sales rose, future single family sales moved on up, and traffic of prospective buyers increased. However, home buyer sentiment fell. Additionally, the lumber prices are up more than 170% since April. That's right. So, real estate is nothing more but a bag of commodities if you really think about it, right? I mean, you have, lumber and copper. That's commodities. You have a lot of plastic, a lot of drywall, right? Maybe you have some, rocks and stuff. So, it's a mixed bag of things. And when the materials go up, like cement and bricks and rocks and that kind of stuff, including lumber and copper, well, of course, that ends up trickling into the homes. And currently, just the lumber alone is adding more than $16,000 to the cost of an average home. Now, of course, we can see that the home builder sentiment is the National Association of House Builders, and you can see that's the green line. And typically, these have been doing pretty, I mean, you can see that they are pretty close to one another, and they have been in the early 90s, the late 90s, the early 2000s, right? They are very, very closely with potentially in the newer times, home builder sentiment slightly leading the whole thing. Then the early 2000s happened, right? And we've kind of dropped. And the interesting piece is that the home builder sentiment fell really, really low in the 2008 to like 11 or so, 12, and then it started to rise up. Home buyers kind of fell a little bit sooner, probably because of the cost of the whole thing. Then it kind of rose up, fell again, and then it started to kind of come on up till about hitting the high. What would this be? In the 13, 14, 15, maybe not 15, right? Maybe right around there. And since then, the home buyer sentiment started to actually drop, while the home builder sentiment continued to go up. And of course, now we're seeing this gap yet again. Then, of course, 2020 hit. Everything shut down. So you see this sharp drop in both the buyer and the builder sector. And then, of course, they continue on up with the home buyer sentiment actually exceeding where we were at the beginning of the year, hitting the 83. And we talked about this, I want to say a week ago, 2 weeks ago. Whereas the home buyer, it did recover from the super low, but it's still not hitting that sort of the most recent high. That's the interesting piece, that their sentiment is not as high. However, we are seeing much higher buys. So things are not quite connecting, right? And you're like, oh man, this is confusing. And I agree with you. Now, here's the piece that the article is talking about, and I agree with a lot of these things. I think it's important, and it kind of ties in with our earlier conversation about New York City and jobs and that kind of stuff. Roughly 80% of new apartment construction is for the high-end luxury market. Now, before we continue, I actually want to pause over here and ask you, why do you think that that is? Now, you got it? Yes, all right. So if you basically said, well, it makes more sense, it's much more profitable, you are absolutely right. Here is part of the challenge, right? You have homes. Now, whether I build for a high end or a low end, my material costs are the same, my permits are the same, my labor costs are the same. Maybe some of the material might be a little bit cheaper once we get inside the house on the decorative pieces, right? Instead of putting the granite countertops, right? Maybe I put laminate, right? So I save a little bit on the cost there. But many other things, there's really not large margin between the things. And then, of course, if it's on the affordable end, I'm not getting as much money. So what they're doing is they're basically building these, are also known just high-end luxury market, but they're also known as A-type properties that they are building because they know that, hey, I can go out there and try to sell this condo at an affordable pace of, 200 to $350,000, but it cost me about 245 to $300, so $100,000. So it doesn't make as much sense from the profitability component. Or same cost, right? Maybe slightly higher, but now I can sell it for half a million, making my margin that much larger. Additional pieces comes in with rentals. Government housing cherry picks the best of the low income renters, providing them with very low rents and nice apartments, and then everybody else basically says you got to go into the private sector. Well, the private sector is basically discouraged from wanting to service because what they're doing is pushing the very challenging group on the folks. And then the problem is also exacerbated by legal and political system that often favors tenants over landlords. And this is right here talking a lot about that Section 8 component that we have here in the United States, where they're on some sort of government support. And there are benefits to definitely renting to Section 8 if you have a good Section 8 in your neighborhood, because they are the ones, the government is the one that actually pays for the rent. However, dealing with those tenants can be much more labor intensive and much more challenging. And sometimes, if you get some bad apples, they don't really care much about that property, and they're much more let's just say damaging to the property, right? They're much more heavy handed when it comes to maintaining it and kind of being nice to the place, as opposed to somebody who is on the higher end of things. So there's sort of the mixed bag of things, but there are some areas that they have to do inspections, and then you have to do all these extra things that you wouldn't have to do otherwise. That is making many people saying, you know what, I don't even want to deal with it, and I understand why that would be, because it can be much more labor intensive, and you may or may not necessarily make as much money from it. We constantly hear about the need for more affordable housing, and are being told this means increasing supply of by building more units. Ultimately, the higher cost of taxes, local fees, utilities, insurance, maintenance costs, general labor, and just about everything flows into the housing market. Of course, it does, because you cannot operate at a deficit for forever unless you're a country, I guess. But if you're a business, you have to make profit. Otherwise, you're not going to be in business for very long. Trends that suggest a growing inability or desire to supply housing that is affordable for middle and working class people. We're hearing that, right? But developers have very little interest in it, or they simply can't afford to do anything about it but add luxury units. There's a huge unhealthy disparity in high end rents versus low end rents across the country, and with building cost being similar between constructing the high end versus the low end units, why would anybody want to deal with the low end of the market? And it makes perfect sense. On the low end here in Providence, for example, the rents, let's take a typical one bedroom, right? On the low end, you can probably find, depending where you go and which areas, if you go into a bit shadier areas of town, you can likely find it as low as about $600-700. But it's very, very shady and very kind of scary, personally speaking. Then you have this mid range that is going to be about $1,000 plus minus. And then you have this high end that is downtown area that is going to range between 2,000 and 3,000. So as you can see, that if you go into the downtown area, right, and if your building costs are very similar, you can go out and rent it for say $2,500 to $3,000 a month, versus if you go into the shady part where you're like kind of scared for your own life sometimes, right, and concerned about like, am I gonna get mugged? To make 500. There's a huge disparity between them, but your costs are very much the same. Well, where would you do business? Of course, you would go in a place where you can make the most. And that's exactly what they're doing. And not just here where I am, but all over the place. The data generally divided into three categories are single family houses, townhouses, small condos, and apartment buildings with 5 or more units. But then it's also important to understand the number being built and who is buying these units and why. And now they're saying that the more attention should be directed towards the ability of the buyer to maintain the home after they purchase it, because there's a lot of talk what they're saying about what do you need to do to qualify to get into it, but not a lot of talk about what happens once you get that puppy. Now, of course, I do talk about that with my students, especially the ones that are starting to invest and have never done it. We got to talk about it, and we got to talk about, hey, things will break, things will be uncertain. You never know what is going to happen. So it's not just necessarily coming down with that, 5% or 3.5% down or 20% down. You have to have for closing costs. You have to have money set for side for like renovations, and things are going to just start creeping up, and they will start creeping up. There is no doubt about it. If you are a homeowner, if you've ever owned a house, a property, anything, you just absolutely know there's more staycations that you do that you can stay at home and fix things up, right? Then you take vacations at times, it feels like. So it is very labor intensive, and so something that people don't always think about, but they should. Now, even with low interest rates, by the time you add in rising real estate taxes and other costs, new homes are expensive. The reality is, new home prices are on the rise, and so are real estate taxes and other fees. While code enforcement has increased, many of the items used in new construction no longer outlive the mortgage, and I agree. For example, you might have to go in and replace doors and windows and heatings and all of that stuff only within a few short years. Then you have houses that are, this particular author is writing, my house is over 100 years old and still has the same doors and windows. How many homes built 30 years ago can support this claim? Enough said. And I think we all can agree that not just with homes, but everything is sort of built to break within a few years to drive the consumer demand even further along. You have some of the hot water boilers and that kind of stuff. They were built in 50s and 60s, and they're still working and operating. And then you have ones that you buy in 2000. By 2009, you had to replace it, right? And even that one was like, woo, it lasted 9 years. They typically last about 5, and they're not the cheapest things to install, right? Because you got to buy that thing, then you got to find a plumber to do it, then you got to pay them for their labor, then they got to show up, right? So there's a lot of cost to it. The housing picture is also muddied because it is difficult to get real-time data. This means we often find we're looking back in the rearview mirror. While the number of permits and building starts give us some indication on the direction of housing, it is a complicated and a fickle market, and I agree. Now, here is the housing permits. So single family housing permits is the blue line. You can see we kind of took this nosedive in the late 2000s, right? And sort of ticked on up, came back down, and we've been kind of going on up since then. And then multifamily permits, didn't take as much of a nosedive. They kind of lagged behind it, but then really picked up and have been basically going sideways over the last, 5, 6 years, right? So, but the new construction is still below the 2008 levels. And if you take a look at where's the 2008 level, it's right over here, right? So this is the permits, but they're saying the actual new construction is still below it. And it's an interesting piece to understand that, hey, you can build get a permit and stuff, but that doesn't mean that it's going to be built, and if it's built, doesn't mean that people are going to come. So we'll see how it all rolls out. I hope that you have enjoyed it and have learned something new here today. If you have, do me a huge favor, smash that like button, do subscribe, hit the bell button, and I will see you maybe tomorrow, most likely not, because I gotta go and play with some of these things, because it's the time for doing, and I gotta go and do before the time for not doing starts, at which point I'm not gonna be doing. So I hope you're well. Enjoy your weekend. Do something fun. Again, if you hit the bell button, you will get notified if we go live or not, and if the new video is available. So you definitely want to do that. And the good news is it costs you absolutely nothing. Zilch. I love that price. And anyways, now we're gonna go and jump into the Q&A for everybody watching live on onedealaway.com. Until next time, stay forever money blessed, and do remember, you are only one deal away.